Hello, everyone. Welcome to our discussion of Chapter 9, especially tax credits. Now, we want to make sure that before we get into the details on these credits, that we have a couple of things in mind. The difference between a deduction and a credit. This is actually after you figure out your taxable income, after you figure out how much tax you owe. These tax credits actually reduce the amount of tax you have to pay dollar for dollar. So a tax deduction reduces your taxable income. So if you have a $50 tax deduction, it reduces your taxable income by $50, and then that reduces how much tax you have to pay in an indirect way because you have less taxable income. A tax credit works more directly. You have your taxable income, you figure out your tax, and then you apply the tax credit to your liability, how much you owe. So that is the important difference. For most people, a tax credit of the same amount is better than a tax deduction because it will reduce directly their taxes, especially if it's exactly the same amount. So these are very important, and there's a lot of detail. Now, the next piece that we need to make sure we can understand is that some tax credits are, in fact, most tax credits are non-refundable, but there are a few that we will discuss that are refundable. And that's important to understand because a credit that is non-refundable can reduce your tax liability, but only down to zero. So, for instance, if you happen to have, let's say, a situation where your standard deduction reduces your taxable income to zero, you have no tax liability. No non-refundable credit will do you any good because you can't, none of that will create a refund. So a non-refundable tax credit cannot create a refund. So we always use non-refundable credits first to reduce our tax liability, and then we apply refundable tax credits because they could make our tax liability not just zero but negative, meaning you're going to get a refund. All right, and we actually have some that are both. That part of it is one way and part of it is another. So those are the kinds of things that you want to plan on, for the most part, looking up. But after a while, some of the common credits you'll get so that you know which one, how it applies, whether it's refundable or non-refundable. So, jumping in, our first credit is, we're going to discuss the Child Independent Care Credit. This is non-refundable. All right, so it's only going to do you good if you have a tax liability. It can reduce it, but it cannot create a refund for the year. So this is basically an idea to cover expenses for the care of your dependent child. Now, they expanded it to other dependents like your mother or father who live in your home and you have to care for them because they are disabled in some way. That also counts in this, so that's why it's really a child and dependent care credit. So you have to have income, or as we'll see, there's an exception to that to make this work. So the thing that you have to, this qualifying expenses are those you pay for the qualifying individual. So you're paying someone to take care of your kids or something like, it could be in your home, it could be at a daycare, it could be several different situations, okay? And the idea is so that you can get a job, and so if there is, that per individual, there's no income that it would indicate that it was not to allow you to get a job. So a qualifying individual includes under 13. You have to be entitled to the dependency deduction. Notice it doesn't have to be a qualifying child. It just has to be a dependent. So it could be your niece or nephew, okay, or some of the other things that are under 13, or the dependent or spouse who are incapable of caring for themselves. So that was an elderly family member or something that could be also a dependent. Now it's a percentage. You figure out your expenses, then you take a percentage. So it's never going to be the full amount. The maximum you're going to credit is 35% of what you spent. So you're not getting back all that you spend in any case. And the amount of your percent depends on your AGI. And there's a chart on these slides and in your textbook. All right, now here's what's kind of complicated. You have limits, all right, on how much you use to calculate this credit. And there's three numbers you have to look at. You have to look at the income of the lowest paid spouse if they're married, filing jointly. If it's single person, this is just their earned income. The amount they spent on child care, daycare, whatever you call it, and you see the limit there, $3,000 if you have one kid or one dependent, or $6,000 if it's two, and it doesn't go up to three or anything. It's just two or more. So you have three numbers, and you get to use the lowest of those three numbers. So unlike some other things we've seen where you've got to choose between two, this is three you have to compare, and you have to use the lowest of those three. Okay, so you're always, these aren't going to change, the 3,000, 6,000, so that usually becomes the limit. But it also could be limited by how much you spent. If you only spent $1,500 on child care, then that becomes the limit. If there's only a little bit of income, that could be the limit. Now, when income is considered, we do have a kind of a caveat, you might say. When one of the spouses is a full-time student, okay, that non-working spouse is treated like they had income. So we're not going to disqualify that situation. So if one spouse is working, okay, the other spouse is doesn't have any wages or earned income, but is a full-time student, we're going to treat them as if they got income of $250 if they have one child, or $500 if they have two children per month that they are a full-time student. If they're not, in months they're not a full-time student, it doesn't count. And so that becomes the limit, because they're going to be obviously the lowest earning spouse, because we're treating that. Now, what I found that students sometimes did is they thought of this as actual income, and they added it on the 1040. No, this is just pretend income for the purposes of this credit. So you're not going to add it onto their income somewhere else, like as extra wages or something. So here's the chart we promised. Notice that it phases out up to 43, but then it never phases out anymore. So $500,000 of income, the credit would still be 20% of whichever of the three numbers is the lowest. Remember, you have your three pieces to compare. It would be 20% of that. When income's very low, it could be as high as 35, but it does go down quickly, as you see. But this is not something you want to remember. Again, you're going to look this up clearly. Example, okay? Jamie is a single mother with one dependent. She has AGI of 75,000, so she's off the chart. So she's going to be at the 20%. She paid $4,500 for qualified daycare, okay? But she's only got one. So the maximum we can consider, remember our three numbers, she's single, so her earned income is 75,000. That's way high. Okay, that's good. It's either how much you pay, that's $4,500, or $3,000. That's that third number we have to compare, and that's the lowest of the three. 3,000 times the 20% from the table, $600. Remember, that is only that's only a benefit if you have liability, because this is a non-refundable credit. Second example, $24,000 AGI, so much lower in the scale. Paid $2,900, but we received $1,000 of help from his employer. Well, just like any kind of reimbursement or anything of any of the other expenses we've looked at, that reduces because the employer is helping them with this $2,900. Okay, so we have to take that off. So now the amount he spent was only $1,900. Remember our three numbers. Okay, income, that's high enough. We got we have some income. We have a situation where we spent $1,900, or maximum of $3,000 is the third number. Remember, we use the lowest, and that's the $1,900 times 30% based on AGI is $570. That's his credit for this situation. So the other thing to think about with the child dependent care credit is it's not available for anyone married filing separately. All right. So this one we're going to go. This one is really rare. You have to be really broke to qualify for this, as you'll see. Basically, you got to have income less than $5,000. Almost everybody has Social Security in excess of this, and so this is seldom an issue. Okay, so I'm not going to spend a lot of time there. I'm going to get on to more complicated, the more common, and that's the education credits. We talked about a deduction for AGI for expenses that are for education, higher education, college, and that sort of thing. This is a credit. This is usually going to be a better situation than the tuition and fees deduction, because usually credits, like we said earlier, are more beneficial than a deduction. So you usually want to explore these first, and then if these don't qualify for some reason, then you could go to the tuition and fees deduction. By the way, you can't do both, okay, in any given year. All right, so it's on the form 8863. So two different types of education credits. American Opportunity Credit is much more beneficial than the Lifetime Learning Credit, as we'll see. So we always want to start with that one to see if we qualify. Qualifying amounts are the same for both. Tuition fees, that sort of thing. Books, this is a little, this is fairly broad, but it does not going to be room and board, that sort of thing. And basically almost all post-secondary institutions. It'd be hard to find an institution that didn't qualify for these. So AOTC first, 100% of the first $2,000 and 25% of the next $2,000. So if you spend $4,000, you get the maximum is $2,500. Any more you spend on those expenses is irrelevant for calculation of this credit, at least. So you are usually at the maximum of $2,500, because $4,000 doesn't get you very far on tuition and stuff. Lifetime Learning Credit is 20% of the maximum of $2,000. Now notice the difference per student. So if I have two kids in college, I could be taking $2,500 for each, perhaps. However, on lifetime learning, it's 20% of qualifying expenses for a maximum of $2,000 per taxpayer. So no matter how many students I have or how many people of our household are going to school, this is a maximum per tax return, per my taxpayer. All right. So it's much more of a reduced amount. Plus, it's 20% instead of 100%. So a big difference there. All right, and you can't use both credits the same year for same expenses. All right, you can't double dip, if you will. All right, so I'm going to stop there and come back to kind of how this works and phases out, the details, and go on. All right, so in part 2.